Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know. First, Fed's 10-9 split on future rate cuts reveals deep internal conflict as a government shutdown threatens a data blackout. We'll explore how this razor-thin majority combined with a data blackout could heighten market volatility and the risk of a policy misstep. Second, gold surges past a record $4,000 an ounce as central banks de-dollarize, and the Bank of England warns of a tech bubble. Today, we'll take a closer look at this market paradox and its implications for a potential major capital rotation out of tech stocks. Third, global M&A activity hits $3.4 trillion, headlined by Electronic Arts' record $55 billion buyout involving Saudi's PIF, triggering national security scrutiny. In this episode, we'll break down this landmark leverage buyout and what it signals for the growing clash between sovereign capital and Western regulators. The Federal Reserve just revealed a deep internal conflict over the future of the economy. While a quarter-point interest rate cut was just approved, the real story is the battle raging inside the central bank, with the decision for future cuts coming down to a single vote. Newly released meeting minutes show officials are split right down the middle on what to do next. A razor-thin 10-9 majority believes 2 more rate cuts are needed before the end of the year, while the other 9 want a more cautious approach. This division, revealed in what's called the dot plot, tells us that future policy is now hanging by a thread. It makes the market extremely sensitive to every new piece of economic data and every public speech from a Fed official, because just one person changing their mind could flip the entire outlook. This division shows just how uncertain the path forward for the economy has become. And a while back, we compared a government shutdown to turning off the Fed's cockpit instruments, the altimeter and speedometer of jobs, and CPI leaving policymakers to fly blind. Today's minutes make that risk more immediate. However, this is where the situation takes a more complex turn. One newly appointed governor, Stephen Miran, was the lone dissenter on the last vote, arguing for a cut twice as large as what was passed. He pushed for a half-point reduction immediately, signalling his belief in a much more aggressive path of easing than anyone else on the committee. So what's driving this dramatic split? A weakening labour market. The minutes reveal most officials now judge that downside risks to employment have significantly increased, forcing their hand toward lowering rates. As we've discussed before, this is an extremely data-dependent Fed, and the twist now is that the data stream itself could be disrupted. The Fed explicitly citing downside risk to employment marks a major shift in their focus. It means that forward-looking labour market data is now the most critical input for their decisions. So for those of you watching the markets, you'll want to pay close attention to indicators like the JOLTS report and weekly jobless claims. A rapid deterioration in these numbers could signal that the Fed will act more aggressively than the market currently expects. They're also weighing the impact of tariffs, which have pushed prices higher this year. Interestingly enough, the Fed seems to believe the inflationary effects of tariffs are temporary. Their view is that these price spikes from trade policy are transient and won't lead to lasting inflation. This implies there's a higher bar for US, China trade friction to actually stop the Fed from cutting rates, which has direct implications for exchange rates and commodity prices. But a bigger problem is looming that could throw all their plans into chaos. A potential government shutdown threatens to cut off the flow of key economic data from the Labour and Commerce departments. We previously walked through how prior shutdowns froze the jobs and CPI releases and even delayed GDP, creating a data blackout. The stakes are higher this time because the minutes reveal that 10-9 split, meaning one mind changing could reset the entire rate path. Essentially, the shutdown has already halted the release of crucial reports like the monthly jobs numbers and the consumer price index. This means at their next meeting, Fed policymakers could be flying blind, forced to make critical decisions without the vital numbers they need. As one economist put it, this is probably the worst time for the Fed to be flying blind. Without official data, they might have to rely on alternative reports, but these can be less reliable. This pivot increases the risk of a policy mistake, creating even more volatility just as the economy enters a critical phase. And as we flagged a while back, the damage isn't just missed reports. Contractors often don't get back pay, confidence can crater into the holiday season, and that psychological shock can amplify any weakness in hiring, exactly the kind of feedback loop the minutes are now worried about. One more thing we noted earlier, some strategists have urged investors to fade shutdown fears. Today's update doesn't settle that debate, but it does raise the stakes. The Fed itself is now highlighting the shutdown risk while sitting on a knife-edge vote count. We were just talking about the Fed flying blind without its key economic data. Well, that very uncertainty is helping fuel a massive surge in the price of gold, which just blew past a record $4,000 an ounce, with spot prices hitting over $4,036. This is the precious metals' biggest rally since the 1970s, rising by around a third since April amid the US government shutdown and ongoing global trade tensions. A while back, we analysed how today's swollen fiscal deficits dwarf those of the 70s. Today's move is the market's latest verdict. Capital is seeking assets without policy or counterparty risk. The US government shutdown has created what some analysts are calling a data blackout premium. Believe it or not, markets are flying blind. Key economic reports on inflation and employment have been suspended. Without this official data, investors are operating on sentiment and proxies, and that uncertainty is inflating gold's price. The strange part is that this means the current rally is partially built on a lack of information, making gold highly vulnerable to a sharp correction once the shutdown ends and the real economic data is finally released. A record $64 billion has poured into gold-backed funds so far this year. We previously noted how some prominent allocators were floating unusually high gold allocations. What's new now is that these flows have gone mainstream. But when we dig into these massive inflows, the picture gets more nuanced. You know, when retail investors rush in late, driven by a fear of missing out or FOMO, it can sometimes signal a speculative peak. And markets that become heavily influenced by these late arriving investors are notoriously vulnerable to sharp reversals if the underlying drivers shift unexpectedly. But the real story is who is buying. Global central banks have collectively bought more than 1,000 tons of gold each year since 2022. That's more than double their average annual purchase over the previous decade. So the thing is, this isn't just about buying a shiny metal, it's a profound strategic shift. This record pace of buying is a leading indicator of a structural trend called de-dollarization. Now, get this. Central banks, particularly in emerging economies, are actively reducing their dependence on the US dollar. According to the IMF's latest COFA report, the dollar's share of global foreign exchange reserves has already dropped from 59% to 55% in just one quarter. This trend suggests a move toward a multipolar currency system, which could establish a new, much higher price floor for gold. And this isn't just about gold's rise, it's about what the smart money is running from. The Bank of England just fired a massive warning shot, declaring that AI tech company valuations appear stretched and that markets face a rising risk of a sharp correction, meaning a fall of more than 10%. If that sounds familiar, it should. The bank's financial committee went on the record stating that on some profit measures, the situation is now comparable to the peak of the dotcom bubble. This is a direct warning aimed at the very tech stocks that have been driving market highs. This creates a fascinating and fractured market. We're seeing simultaneous rallies in both high-risk tech stocks and the ultimate safe haven asset, gold. It's a paradox. It suggests that while some investors are chasing high returns in tech, a growing number of sophisticated investors see that rally as fragile. A tech correction, like the one being warned about, could trigger a massive capital rotation with money fleeing tech stocks and pouring directly into gold, pushing its price even higher. Another layer to this is what analysts are calling a Fed credibility risk premium being priced into gold. Historically, gold was a hedge against inflation, but now it's also becoming a hedge against institutional decay. When there is overt political pressure on a central bank like the Federal Reserve, markets start to worry that it might make decisions for political reasons rather than economic ones. That historical parallel is causing investors to demand a premium for this risk, which could sustain gold's high price even if other economic data looks strong. The unprecedented rush into gold is not just a rally, it is a clear verdict on the market, signaling a massive loss of faith in a tech-driven boom and a global pivot away from traditional reliance on US assets. So, what should we watch for next? First, the end of the US government shutdown. Second, the relationship between the Nasdaq and gold. Finally, the long-term trend to watch is the quarterly IMF COFA data, which will tell us if global central banks are continuing their strategic march away from the dollar. While we're seeing some smart money hedge against a tech bubble, another part of the market is betting big in the opposite direction. Global deal making is roaring back to life, with mergers and acquisitions hitting over $3.4 trillion in 9 months. A staggering 32% jump year on year and the strongest showing since 2021. For a long time, deal makers were frozen, waiting to see what central banks would do. But for them, certainty is often more valuable than cheap money. So even though borrowing costs are still high, the moment the Federal Reserve signaled that the rate hiking cycle was likely over, it was like a starting gun went off, giving boardrooms the clarity they needed to pull the trigger on long delayed plans. This isn't a slow burn, it's an explosion. The third quarter alone saw $1.29 trillion in deal value as boardrooms officially shifted from wait and see to action mode. The engine behind this? A record-breaking 49 megadeals valued at $10 billion or more. The marquee moments include Union Pacific's $85 billion acquisition of Norfolk Southern. Then came the bombshell, Electronic Arts' $55 billion take-private deal, which now stands as the largest leveraged buyout in history. What really brought this to a head was the EA deal, not just because of its massive size, but because of who is behind the buyout. The consortium includes Saudi Arabia's Public Investment Fund, or PIF. This highlights a new trend of state-backed sovereign wealth funds acquiring strategic Western tech assets. Deals like this automatically attract intense scrutiny from regulators like CFIUS in the US, which will review the transaction for national security risks, adding a whole layer of geopolitical drama. So what's fueling this fire? Pent-up demand and an ocean of cash. The global private equity industry is sitting on $1.2 trillion in dry powder, just waiting to be deployed. What's actually happening is a massive corporate reshuffle. Selling off non-core businesses isn't just about tidying up the balance sheet. It's a strategic move to raise cash to fund huge bets on new technology, especially AI. This is a leading indicator of where capital will flow next and will fundamentally reshape entire industries. But this is not a rerun of 2021's easy money frenzy. The situation presents a fascinating duality. On one side, you have these giant, well-capitalized companies making mega deals. On the other, smaller firms are struggling with sluggish, small and mid-cap deal making. This could accelerate industry consolidation, where the big players get even bigger. There's a standoff. Sellers are still anchored to sky-high 2021 valuations, while buyers are grappling with today's financing costs. Wall Street's investment banking engines are running hot again, with Jefferies posting its third best quarterly advisory fees. When we place this alongside a giant like JP Morgan, which recently reported a nearly 50% jump in investment banking fees, it confirms the boom is real. This revival is great for financial sector profits, but also raises the question of whether profits are only going to the handful of top-tier banks handling the mega deals, tying back to that barbell trend. The consensus is clear. Stakeholder pressure to grow is triggering more divestitures and acquisitions. As one executive from EY Parthenon stated, leaders have accepted high uncertainty as the new normal and are now focused on their next cycle of growth.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.